All right, everybody, it is time for a new YouTube video. I've been wanting to do this one for a while because I see a lot of information out on social media where there's a lot of people that just invest only in stocks, and I think there's some misconceptions about index funds and everything being risk-free, and I want to clear the air. And this is coming from somebody that was working in 2008, 2009. I was investing at the time. I had a good bit of money already saved up. And I remember seeing my investments go down quite a bit. And the scary part was I had coworkers and managers that were in their late 50s, early 60s that had saved up a low seven-figure portfolio. Like they might have had $1 million to $1.5 million in their 401ks, only to see that get cut in half. And that is a scary feeling, especially when you're that close to retirement. And I think what people forget is risk management. Your goal needs to be to take the minimum amount of risk to get the return that you need. Let me repeat that. You need to take the minimum amount of risk to get the return you need. And here's what I mean by that. If you make $1 million a year and you live on $50,000 a year, right? And let's say after taxes, you can save $400,000 or $500,000. Let's say that. In that case, do you really need to invest in anything aggressive to hit your goals? If your goal is to live on $50,000 a year? No. You could save up cash. You could be mostly cash and save it up and then have enough to retire early in a few years. That's an extreme example, but it makes the point. That person doesn't have to take a lot of risk. Whereas somebody that's making $50,000 a year and wants to retire on $50,000 and they want to do it, let's say in 20 years, they're going to have to save a lot, and they're going to have to also invest aggressively. So they're going to have to invest in a way to maximize their return. The higher the return that you seek, the more risk you will have to take. So just be aware of that. Now, everyone just talks about the index funds and like they're being risk-free. They're not. And I want to explain this because I think too many people get all invested in stocks, and then when the market turns against them, they'll sell at the worst time. And they do that because they did not manage their risk properly. They panicked and they sold. So I want to show you how just the power of adding one asset class can help you manage your returns. Now, for asset classes, this could be anything. This could be crypto. This could be real estate. This could be bonds. This could be, more stocks, foreign stocks, emerging market stocks. Just don't think on one, don't buy just one fund and forget it. Buy diversification. Get that diversification in your portfolio. That will help you sleep better at night. So I'm going to go through here and I'm going to walk through an example using Portfolio Visualizer. Portfolio Visualizer, if you don't know, is a fantastic tool that will allow you to look there. A lot of the features you have to pay for, but some of the free ones are fantastic. And so I want to walk you through using this tool, just the power of what an asset class, adding one asset class can do to your returns, and also how it can reduce your risk. So I'm going to use this. I'm not going to change any of these. If you'd like me to, I can always do a separate YouTube video and kind of walk through all the settings here, but we don't need to for what we want. And so I'm going to start with VFIAX. Now that is the Vanguard S&P 500 index fund that tracks the 500 largest companies in the United States by market cap. So market cap is the number of shares a company has, stock shares times the price. So a rough, quick and dirty estimation of the company's value at a moment in time. Now, that generally means that companies like Apple, Microsoft, Facebook or Meta, whatever, Google, Amazon are going to be your biggest holdings in there. And if you look at that fund, they indeed are. I'm also going to pull up PEDIX. This is a PIMCO extended duration, which basically means it is buying treasury bonds, United States government treasury bonds that are they're 30-year bonds. That means if you bought one now, they're not gonna pay you back your principal for 30 years, but they'll pay you interest and stuff. And actually this one, I don't want to get too technical, it actually buys zero coupon bonds, which means the interest rate is baked into the price. So you might get it for 50 cents on the dollar, but if you hold it to maturity, you'll get your full dollar. So it's one of those. And let's do a Bitcoin one. I don't know if I can even do Bitcoin market price. We'll do that one. So in the first portfolio, we'll do a 100%. Actually, I'm gonna take away the Bitcoin. We're just gonna walk through two examples and then I'll go back and we'll add Bitcoin. How's that? We'll do a 70-30. Now, what this means is this first portfolio is all in Vanguard, all in the S&P 500. This one, 70% is that. I added 30% bonds. And let's walk through it. So you can see here, this portfolio one is S&P, this one is a bit mix. And I want to point out some numbers to you. So you look at this, you're looking at the chart. What is the one thing that you notice right off the bat is you notice that portfolio two is ahead. Even after the run up in growth, you notice that portfolio two has more money. Isn't that interesting? Why is that? Well, let's zoom in on 2008 and 2009. 2009 is when you had the bottom, but because treasuries protected you so well, you didn't lose that much. In the whole blip of things, you did not lose that much money there. Versus this went, if you look right here, you were at $10,000 in portfolio two, and you are a little bit on, 9,300. You went from 9,300 in portfolio one to 5,400. So you got cut almost in half. Whereas here, I went from 99, almost 10,000, down to about 77. So you're down maybe 20%. That helps you. Losses matter. And this is an example of why. And as you can see over time, even a fully 100% stock portfolio cannot catch up. This is exactly why you should not ignore bonds, and you should have a diversified portfolio of different asset classes that don't correlate to each other because of stuff like this. And this you're going from 2007 all the way to 2021. You can see that it does add up. And you can see the balance is higher. You got an extra percent rate of return almost. Standard deviation is key here. That's how much volatility is in your portfolio. The lower the number, the smoother the ride. You won't have plus 50%, minus 50% stuff. It'll be a little bit smoother of a ride. You can see about 30% lower here, 15 to 10. That's a big deal. That might mean the difference between you panic selling and you being able to sleep at night saying, okay, it's down a little bit, I can manage. Just be aware of this. Be aware of this stuff. Look at your worst year. Like it was only down 11% versus 36. And your max drawdown. So from top to bottom, 50%. And this was back in November 2007 to February 2009. This is only 28. Do you not think that doesn't matter? I think it absolutely matters. And Sharpe ratios and Sortino ratios are all about risk adjustment. The higher the number, the higher the risk adjusted rate of return. About almost 50% higher, I think. I think that's crazy to me that adding those bonds helped you that much. And so this is the key to diversification. This is why you need to be diversified in different asset classes. Now, will bonds do the same in the future if there's a market crash? I don't know. But I can tell you right now, if the S&P goes down 50%, I'm going to go down 50% in an S&P fund. So it is important for you to know, and especially as you get closer to retirement, that you need to manage this risk. Now, let's go back and add Bitcoin here, like I was gonna say. And I'm just gonna add the market price. And let's just say, we'll say, let's say we add, I don't know, we'll add 3%. And I'm gonna take it from, I'll take it from my stocks. You could do this however you want, play around with it however you want, but let's just do it this way. Let's see what happens. I only added 3% and I only added it to Bitcoin. So let's watch. Now you're going to see that this is a lot later now. So the results will be different. What you can see, and again, this is from January 2014. The other one was from 2007. So we don't have that 2008, 2009 in there now. But what you can see now is adding that little bit of Bitcoin. So this is 100% S&P. This is with the 70-30. Now you notice this time it's slower because you're starting at a different time period. So you don't have that big crash now at this point to compare it to. And then you also have this. This is adding the Bitcoin. Look at how much different it is. It's a lot higher. And that's only with 3% Bitcoin. You can clearly see, risk adjusted, how much outperformance it gave you. And so my point is, now you're adding you're layering on another asset class that you can do that will help diversify you. So this is why it is important when you think about building your investment portfolio. In my opinion, not financial advice, you do what you want. I'm here to educate. This is why I believe that you need to build a portfolio of having different assets. There's nothing wrong with having bonds. There's nothing wrong with having real estate. There's nothing wrong with having Bitcoin. I like doing a little bit in all of them, because at the end of the day, your goal is to sleep at night and for your investments to make you money. But if you're stressing out at night, worried about a market pullback, then you are taking on too much risk. And I would recommend looking at your portfolio and seeing if there are things that you can change. So again, this is the importance of managing risk. I cannot say it enough. Please, 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 please manage your risk. And so I hope you got a lot of value out of this today. I'll be posting this on YouTube. And if you have any questions, please drop them down in the comments. I'm happy to answer them as I'm able to. I check the comments maybe about once a day. But if you have other content ideas, let me know. Some of those best ideas I will turn into new videos. And I will also be talking about some of this stuff on Instagram. So again, if you have questions, let me know. And I hope you guys all have a great day. Stay safe, stay out of trouble.